Hi, it's Suzy Rhoades here with PassMasters. Welcome to this week's Questions of the Week. This week, our topic is advanced derivatives. You can expect this topic to appear on your Series 7 exam. We'll be taking a 20-question topic quiz from within our PassMasters Series 7 course. Let's check out our learning management system. Morgan purchases one GM May 50 call at 5 and sells one GM May 60 call at 2. She will profit when which of the followings happen? So we have 4 choices here, but before we even look at those, I need to get this written down. So when you're taking your test, you have to write on your scratch paper erasable whiteboard thingy. You shouldn't just try to do all of this in your head. So what do we have here? Morgan purchased a call and she sold a call. So we have a call spread. So let's write it down. Buys one GM May 50 call at 5. Sells one GM May 60 call at 2. So the buying of the call is money out of her pocket. So I'm going to put a negative sign there. The selling of the call brings money into her pocket. So the net of the premiums is a -3. When you have a question about a spread, there's a handful of questions that the test is going to ask you. So first off, when this is negative, it is a debit spread. And this becomes, when it's a negative number, the most that Morgan can lose. So 3 times 100, $300 would be the most in this position that Morgan could lose. How much can she make? Well, the spread, the difference between the strike prices is 10. 10 minus the premium, net of the premium. So I say the absolute value of the premium. So the absolute value of -3 would be 3. 10 minus 3 is 7. So 7 times 100. When this is negative, that's the most she can lose. 7 times 100 is the most that she can make. $700. We know that it is a price spread. It's a vertical spread because the expiration month is the same and the strike prices are different. When this is a negative net of the premiums and it's a debit spread, what happens when you go to the doctor? They say open up and don't forget to exercise. So that just helps me remember debit spread. Morgan wants the spread to widen and the options to be exercised. On a spread, not this question, I don't think, but oftentimes they ask you what is break even. So we have 2 strike prices. So here you are fishing at the lake. I'll pretend I can draw because I really can't. And then you've got your fishies in the lake. What you're going to do is you're going to take the 2 strike prices, and at the bottom of the lake is the lower number, and at the top of the lake is the higher number, and we call up the fishies, call up. We're going to come up by the net of the premiums. So 50 plus the net of the premiums is 3. Break even here is 53. That's all the questions I think that they're going to ask you about a spread. Let's go back to the question. So the question's asking, how is Morgan going to profit with this spread? 1, the spread between the premiums narrows. Does she want it to narrow or widen? She wants it to widen. So 1, not correct. 2, correct. 3, the options expire unexercised, or 4, both contracts are exercised. Yes. So the correct answer is 2 and 4. So you click what you believe is the correct answer. Click check answer. You can click show explanation. I know I got it right because I got a green check mark. And then we have a written out explanation and Morgan purchases one GM. It's me. So every one of our questions in our courses has an audio explanation, so that if you learn by listening, this is going to appeal to you. Some people learn by reading, some people like all the examples, and some people can just learn when they listen. So different learning styles. We try to appeal to all of them. On the same day in a margin account, Woody buys one UPS January 200 put at 2 and sells one UPS January 210 put at 6 when the market price of UPS is 207. What is the most that he can make? So with Morgan, we had a call spread. With Woody, we have a put spread. So buying a put and selling a put creates a put spread. So when he bought the put, he was out 2, he was in 6. So here we have a positive 4 for the net of the premiums. That means it's a credit spread. So same lake story, we're gonna have, draw a lake on your scratch paper. It sounds cheesy, but it's so helpful. The number that goes on the bottom is the lower of the two strike prices, 200 and then 210 at the top. Now we're gonna put down our fishing line, or put down, just that helps me remember, put down by the net of the premiums. So 210 minus 4 gets us to 206. 206 is Woody's break even. What's the most that he can make? Well, the net of the premiums was positive. So we had a positive 4. When that's a positive number, that is the most that he can make. So 400 is the most that Woody can make. How much can he lose? Well, the difference between the strike prices is 10. 10 minus absolute value of the net of the premiums, 4 is 6. 600 is the most that he can lose. 400 is the most that he can make. It's also true that this is a positive number, right? The net of the premiums was plus 4. It's a credit spread. So that means that Woody wants the spread to narrow, the difference between the premiums to get smaller, and the options to expire unexercised. So debit spread, widen and exercise, credit spread, narrow and expire. A customer with no others securities position purchases one RET July 30 call for $2.75 and purchases one RET July 30 put for $125. What is the maximum loss the customer could sustain by the expiration date of the options? So what do we got here? We've got a long straddle. So bought a call and bought a put. So $2.75 plus $1.25 is $4 a share. When you buy options, the most you can lose is whatever you paid for them. In this case, $4 a share times 100 shares, $400. The most that this customer could lose. The most they can make is unlimited because they bought a call. Calls have unlimited upside profit potential. In December, Phil purchased one XYZ March 72 call and sold one XYZ January 72 call on the same day in his margin account. Which of the following must occur in order for this position to be profitable? So here we have purchased and sold calls, so call spread, but we don't have any premiums, which is kind of suspicious. We have a calendar spread, so the expiration dates are different. So think about it. Which one of these did Phil have a higher premium? The buying of the call, it expires in March, or the selling of the call? Well, March is further away than January in a calendar, so I'm going to you have to assume that he paid a higher premium than he received when he sold the call, simply because of time value. So if he's out more than he's in, he has a debit spread. When you have a debit spread, you want the difference between the premiums, the spread to widen, and the options to exercise. So the question says, which of the following must occur in order for this position to be profitable? Both contracts must expire out of the money? No. The spread between the premiums widens? I like that. The spread between the premiums narrows, or both contracts must be exercised. We want, in this question, the spread between the premiums to widen. Because the strike price on both of these contracts is the same, there is no benefit in having both of the contracts exercised. Normally, when we have a debit spread, a lot of spreads are the vertical spread where the prices are different, but here we had the prices the same. When must a customer receive a current options disclosure document? Not later than the time that the customer places an order for an options transaction, at or prior to the time that the customer's account is approved for options transactions, not later than the time that the customer receives confirmation of the initial options transaction, or within 15 days from the time that the customer's account is approved for options transactions. So pick the best answer, at or prior to the time that the customer's account is approved for options transactions. The customer must receive a current options disclosure document. It's written by the OCC. It's characteristics and risks of standardized options. If options are interesting to you, I assume if you're taking the Series 7 test that they are, you would want to read it. There's way more actually in the options disclosure document than is on the exam, but it is a really interesting large amount of information. Check it out. In August, a customer sells one ABC October 20 put for 5 and sells one ABC October 20 call for 3. Sells a put, sells a call. We have a short straddle, same underlying security, same expiration, same strike, when the price of the underlying stock is 18. If the call is exercised and the stock is purchased and delivered at 29 and the put expires unexercised, the profit or loss would be, what? That's so much. I gotta write this stuff down. So we're gonna make a T-chart here. Sells a put for 5. So in their pocket 5, sells a call for 3. So far total in their pocket 8. If the call is exercised and the stock is purchased and delivered at 29. So the market price is 29. Sold a call. They have to go into the market and buy the shares. It doesn't say that they own the shares, so they have to buy the shares at 29. They can turn around and sell the shares at the strike price. The strike price in the call is 20. So total in their pocket, 28. Total out of their pocket, 29. It says that the put expires unexercised for a net -1 position times 100 shares. So it is a $100 loss. Use your scratch paper. It's very helpful. Which of the following investors would realize a profit if the market price of the underlying security remains the same? If you're the buyer of an at-the-money put, you want the price to do what? Go up or go down? If you buy a put, you want the price to go down. So it's not 1. 2, the buyer of a straddle. A straddle buyer buys a call and buys a put. They pay 2 premiums. When you buy a straddle, you want the price to move outside of the box. Remember the options chart and how the arrows for the buy a call goes up and buy a put goes down. The profit in a long straddle is outside of the box. So the buyer of a straddle would not profit if the price remained the same. The seller of an at-the-money put. When you sell a put, what are you, bullish or bearish? You're bullish, or you're perfectly happy if the price goes sideways. You just don't want it to be exercised. So the seller of an at-the-money put would profit if the market price stayed the same. So would the seller of a straddle. So when you sell a straddle, you sell a call and sell a put, collecting 2 premiums. The profit is in the box. You do not want the options to be exercised. You want the price to stay unchanged. So 3 and 4. A customer with no other securities position purchases one RET July 30 call for $2.75 and purchases one RET July 30 put for $1.25. So total out of their pocket to establish this position is $4. So we have buy a call and buy a put, same underlying security, same expiration month, same strike price. We have a long straddle. When you have a long straddle, this is my suggestion. Take the strike price, it goes in the middle, and you're going to find there's going to be break even on the upside. You're going to take the strike price plus the premiums, so 34, and there's going to be break even on the downside. So 30 minus 4 is 26. The profit is outside of the box. I referenced that earlier. You might have been wondering if I was losing it. I wasn't, I swear. The profit is outside of the box. So if the RET stock price moves to 38 at expiration, well, 38 is where? Outside or inside the box? It's outside the box by how much? By 4 times 100 shares, a $400 profit. It is true, if you don't want to make the box, that you can actually finish your thought process with this position. So if the stock price moves to 38, does the put have any value? No. What is the investor going to do? The investor is going to buy the shares at 30. So they're going to be out 30 for a total that they're out 34. And then they're going to turn around and sell them at the market price of 38. For a net position, 34 versus 38 of a positive 4 times 100, 400. So you get the same answer either way. It's a matter of what you're most comfortable, how you like to do it. Up to you. Your client purchased XYZ stock at 60. The stock is now 70. Your client believes the price will decline to 65. He should do which of the following? Buy a straddle at 70. Buy a 70 call and write a 70 put, write a 60 call and buy a 70 put, or sell a straddle at 70. When you own stock, you buy a put to hedge the downside risk. Now, in this case, the inventory position was lower than the current market price, so that if you buy a put at 70 and the price goes below 70, you're actually locking in their profit. So buying a put at 70, yes. And they own the stock. So if they write a 60 call, when you write a call, are you bearish or bullish? You're bearish. And that's what this investor is. They believe that the market price is going to go down. So they would collect a premium. And if they were wrong and the shares were called away, at least they already own the shares. So write a 60 call and buy a 70 put. Which of the following would be considered the riskiest investment? Buying puts. How much can you lose when you buy a put? Whatever you paid for it, the premium. Selling uncovered calls. You're naked. Is that risky? Yeah, you better believe it. I'm pretty sure that's going to be the right answer, but we're going to read all of our choices. Selling uncovered puts or buying calls. Definitely of those, the riskiest investment would be selling naked uncovered calls. Don't do it. Your broker-dealer's never going to let you do it anyway. Which of the following is responsible for guaranteeing a listed option? The member firm, the exchange where the stock is listed, the Options Clearing Corporation, or the Federal Reserve Board. It is the OCC, the Options Clearing Corporation, that guarantees listed options. They're also the ones that write the options disclosure document. Concerning the exercise of exchange-traded index options, which of the following is a requirement? So index options, delivery of securities on the 5th business day. Can anybody deliver an index? No, index options settle in cash. Cash payment on the next business day. I like that. Cash payment on the 5th business day. Delivery of securities on the next business day. It is cash payment on the next business day. Which of the following could not be used to cover short call options in a cash account? When you sell a call, you've sold an obligation to sell shares at their strike price. Owning the shares covers the call. So this question is asking what does not cover a call. Choices include escrow receipts, the underlying stock, bank guarantee letter, or convertible bonds. So escrow receipts, the underlying stock, and convertible bonds, assuming it's convertible into the shares of stock that you just sold the call on, those all cover a short call. It is the bank guarantee letter. Cash covers a put. Cash does not cover the sale of a call. If a customer was seeking income from a blue chip stock portfolio, which of the following option strategies would be the most appropriate? So income, they own stocks. Blue chips move sort of sideways. Choices include uncovered put writing, covered put writing, spreading calls or puts, or covered call writing. Covered call writing. The premium that's collected, that's income. And of course, the investor, when they sell a covered call, hopes the shares don't get called away. But if they are called away, at least they already own the shares. They are not naked. They're covered. An investor purchases one XYZ January 60 put at 8. So bought the option at 8 and sells one XYZ January 50 put at 1. So out 8 in 1, we're at a -7. This is a put spread. When this number is negative, it is the most that the client can lose. The difference between the strike prices is 10. 10 minus the absolute value of the net of the premiums is 3. That is the most that the client can make. We're going to draw our lake. The higher of the strike prices goes on top, 60, and then 50. And what do? Do we call up, put down? We put down by the net of the premiums. So we go all the way down to 53. This is the investor's break even for this put spread. A customer decides to sell 10 uncovered BVD June 40 calls at $4.75 when the underlying stock is trading at $42. If the customer closed out the options at $2.13, what is her gain? So I got to make a chart. So in her pocket, $4.75 when she sold the calls. So it is, the first thing that she did is called an opening sale. So she's going to have to do a closing purchase. So it says that she closed out the positions at $2.13. So $4.75 minus $2.13. So a positive $2.62 times, let's see, 100 shares? No, times 1,000 shares because there are 10 contracts. So be very careful for the number of contracts. So $2.62 times 1,000 is $2,620. A customer owns 500 shares of ABC and believes the market may decline. To partially hedge his position and generate some income, he would. So owning stock is bullish, and the downside risk can be hedged by buying a put, that would be a primary hedge, or selling a call. So it says here to partially hedge. So selling a call is a secondary hedge. It only protects the downside risk by the amount of premium collected. It also generates some income. So we're going to sell, choices include 5 ABC out of the money calls, Buy, no. Sell 5 ABC out of the money puts, no. So it's sell calls. Sell calls, selling calls is bearish. Buying calls is bullish, selling calls is bearish. The hedge always has to protect where the risk is. Which of the following orders would have priority at the opening of the CBOE? That's the Chicago Board of Options Exchange. Spreads executed on a one-to-one basis, all market orders, public market orders, or limit orders at the opening price. What has priority at the opening? Public market orders. If your customer buys 3 XYZ September 50 calls at $1.50 when the stock is at $47.50, your customer's break-even point is, well, what's break-even on a call? Strike price plus premium, 50 plus $1.50, $51.50. So the fact that there was 3 was really just there to throw you off. It was just a question about break even on a call. In January, a customer buys 100 RET at $70 per share and buys 1 RET April 70 put at 4. At expiration, RET is selling at $80 per share, and the customer allows the put to expire and sells long RET shares at $80. What would be his pre-tax profit? So I'm going to make a T-chart. What we have here is a stock purchased at 70 with a put purchased at 4. So we call this a married put. So 74 is the cost basis. The shares are sold, money in the investor's pocket at 80, leaving them with a net position of $6 a share. Times 100 shares, $600 would be the customer's pre-tax profit. That's it for this week's questions of the week. Topic was advanced derivatives. If you learned something, be sure to give this video a thumbs up. Subscribe to our channel and turn those notifications on. We are always putting out new content. If you would like to check out our PassMasters course offerings or to enroll in any of our programs, there is a link found in this video's description. Thank you so much for watching. I hope to have you as a student soon. Happy studies! You got this.